Hey guys, welcome to the Trade Genius podcast. Bob and Phil here. Guys, a lot of volatility in the market. Markets pulled back today, but we're going to tell you about some important levels here. We're also going to show you a couple markets that one is going to crash or the other is going to crash. We're going to talk about exactly what that means, which markets those are. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob. So I know in the previous video when we were talking about the what to look for when things crash, we said that you had mentioned the 50-day moving average on the SPX was a key level. We actually broke that today. Whether or not we get back over it before the end of the day remains to be seen. But what do you think? Is this really the move, or do you think we're getting a little bit of a head fake here?
Yeah, and maybe we could flip to that chart before we talk about the oil chart. So what's really interesting to me is pretty funny. You and I last week were talking about, hey, we should be higher into OPEX, which is the 15th of September.
Right.
And I said I was a little nervous for the first full week in September, which is considered week 2 because it's prior to OPEX.
Right.
And we had this Thursday down, Friday up, Tuesday down. Looks like Wednesday's going to be down, but they did something really interesting today. I think they did the scare the children move, Phil, breaking the 50, getting all the bears really excited. But then it came right into the 20-day moving average and it stoned the move down.
Right.
And so what we need to look for now is if it breaks below the 20, the crash signal is still on. But if it reacquires the 50-day moving average, which statistically going into an OPEX week, like the way we're going into right now, we expect it to reclaim that 50-day. And if it reclaims that 50-day, Phil, you have some levels for it to go all the way up to. Can you want to share those?
Yeah, I mean, you can see it on the SPY chart here too. If we're just speaking to the SPY, which I think most retail investors are look to the SPY, and essentially that means going up to that 455.49 level, a little higher, just to close that gap from that day, get to that closing print level of that red doji candle up there. So, if you think about the markets and like what causes the most pain, in reality, what it is where's all the liquidity? So when we're in an environment where we're negative gamma, which means that we are in a situation where we're below a lot of the hedging walls. And so what happens is volatility spikes up under zero gamma. Volatility spikes up under things like the volatility trigger, which are just simply levels that coincide with where the big hedge walls are in the SPY options market, or the SPX index options market, because you can have options on the SPX index itself. So we're in a situation where we're negative gamma. That means high volatility. What that simply means is that the dealers that are dealing options to the retail customers or institutional clients must trade with price action. So that makes the moves a lot more wild, and you get that roller coaster effect. And versus a positive gamma environment where they actually thicken up the books because they actually trade against price action. So it makes the moves more docile. You get more trend-like moves and less just sporadic. You're like, what's going on? The market seems so wacky, and that's what you get in a negative gamma environment. Sharp moves. That's why I think this move down exasperated today, Bob. But like you said, we hit the 20 SMA, we hit the weekly 9, which for us at Trade Genius is an important level, and we're bouncing off of it. So when you get a pullback after an initial break higher and you pull back to a key level like the weekly 9, that's where sometimes you get the biggest bounces. So long story short, this is where I think you can engineer a move. That's how these markets work. They go for the biggest sources of liquidity, and now you got probably a big pocket of liquidity sitting above that recent swing high that we just fell down from, Bob. And I think it's a perfectly engineered move to go up there. Now I could be wrong. If we don't get back above the 50 daily SMA like you said, then it kind of invalidates that thesis to a degree. But if we do start popping over it and we start moving up into Globex tonight in the overnight session in Europe, then I think we definitely could have a potential squeeze now that's engineered to go into OPEX, as we know that the options hedging that was favorable for that to be a positive move next week, right? And then after that, look out below. I think that 50 becomes very, very important, that 50 SMA on the daily level.
Yeah, I totally agree. So Thursday, Friday, if we're positive, then we're going to have probably what's called a normal OPEX week, where it should be generally positive. But if we can't reclaim that 50-day moving average, people really need to get nervous. Our view is, I think you and I are in agreement now that we should reclaim it. But guys, trade what you see. But if it breaks to 20, if it breaks today's low, then there's going to be a lot more pain in the market. And what's going to be causing that pain is the next chart we're going to be showing you. You know, it doesn't look like it here because this is actually a quarterly chart of oil, okay? And what's really interesting here is that they drove the price of oil down. Primarily, a lot of it had to do with, number one was the fracking phenomenon, which made the United States the largest producer of petroleum in the world. And then we became an exporter. Then Trump really doubled down on it. But ever since the Biden administration has been in power, there's been a change in the supply-demand balance. And you could see after COVID, which I don't blame on Biden, you know, once Biden took power, Phil, you know, he was dealing with COVID, which I don't put that on him for the oil price. It basically collapsed because of supply demand. But after that, oil has been pushing up higher and higher and higher. And basically production in the United States has fallen off a cliff. And I did some charts here just to show these are reclaims here. We have a bullish reclaim here on the quarterly for oil. So we crossed back up above this line here. And once now we climbed over this $85, $86 area, we're bringing $115 back into the game here. Now, this little green line I have here, that's a measured move. This is where I expect oil to go in the short term. But Russia and Saudi Arabia are now the swing producers. We are no longer the swing producer of oil, and they're going to probably push this up to this rectangle here. We better hope and pray we don't get into this rectangle here, this move here of the 2009, to 2015 area, which would devastate the stock market. You know, people say, Bob, will oil go down if the stock market goes down? Well, if oil's going up, is the cause for the stock market going down? The answer is no. And this is what I'm watching for too. So if oil loses, basically goes back down below $80 a barrel again, then it's going to go down. It's going to start testing these lower parts of this rectangle. Obviously can't go to negative 58, but it's going to probably test back down to the $60 area. If not, it's going to drive the price of the indexes down because it's going to wash inflation all the way through the markets, and Powell's going to be in a situation where he can't relent, and I think it's going to blow the market up. So that's my view on this, Phil. But I think you have another chart to show too, where liquidity is pouring back into this market again. Yeah,
and just for you guys, when Bob's saying rectangles, what he means, and if you're just listening to the chart, what he means is he's got this range highlighted here, and that bottom half of that range, that's the first rectangle that spans from $84.51 up to $135.50, and then from the upper part of that range, the other half is 135.56 on up to 186. So that's what he meant by those two rectangles. So we're breaking back I love these charts. I love ranges, and Bob's highlighted it perfectly here. And like he said, we got this bullish reclaim over 84.50. So that does basically open up a run up to 135.56. Most people would tell you that's no way, but that's how these markets work. They go back to the other side of the range, and you can see that's a big swing low up there that would be back tested. So that would probably be your first resistance. Now, if it gets back over that, then what Bob was saying, to the very top of that range from the 09 era, 186, you're pushing up into 200. And I think if you go over 186, you're actually going to ring the bell at 200, just because commodities get really strong as you roll over to a recession. I know it's counterintuitive, but very bullish. Don't fade that move. And then if you get back under 186, that's probably done. All right, to the next chart. This is reverse repo. Why are we showing you the reverse repo? What is reverse repo? It's the slush fund that the Fed created for the banks that allowed them to basically park reserves at the overnight Fed window and get free money overnight. And where'd that free money come? It comes out of your hide in forms of inflation ultimately, but that's a dirty little secret they don't like to talk about. Is it always available, this RRP? No. This is just, normally it only appears when they feel like banks are in trouble. And basically what this means is that they have left this window open long, probably past when it should have. But then we had that March banking crisis, and now, you know, they're not going to get rid of it anytime soon. So this RRP, which isn't always in the market, is a part of the market now that we need to deal with. This is part of the Fed liquidity model. It's one of the components, but as of late, and the reason why it's been basically the main driver of the markets is because of the way Yellen has been issuing out the debt since the debt ceiling deal was hit and they raised the debt ceiling back in June. It's been for all intents and purposes, it's basically been T-bills, which is unusual to have a concentration of just T-bills and not longer duration things like coupons and notes, and which are usually the longer term duration, like, you know, your 10-year, your 20-year, your 30-year, stuff like that. So as you can see, the blue line is the reverse repo. The orange line is the S&P 500. The blue line reverse repo has just been shooting up higher, and a little bit of a bearish divergence in the reading here versus the S&P 500. The S&P 500 just dipped to the weekly 9 EMA. So you have reverse repo pointing for a move higher. You have a bounce off the weekly 9 EMA. So in my view, this is a good dip buying opportunity, and I think we're going to potentially see that move, like we said, up to that gap fill that you guys saw on the futures on ES. That would mean a move toward 4,600, and futures are getting closely aligned with the actual S&P 500 numbers. So that would also mean that you'd see S&P 500 bounce up to 4,600 from these levels. So in my view, because of the way the liquidity is pointing, and this has, I mean, it's pretty obvious on the chart here. You can see that they move in tandem, and we have a little bit of a dislocation here. But ultimately, I think that because of the RRP printing these higher levels, S&P 500 catches up to it versus leading down. So I do think we have a potential for that move to happen here over the next week into OPEX, Bob.
No, it's just amazing how, you know, you can look at charts and you can look at fundamentals, but when the Fed decides to wash, or the Treasury decides to wash liquidity in and out of these markets, they can just move them anywhere they want to move. And that's why it's so important to look at this stuff behind the scenes.
Right. Yeah. So important component. Guys, what do you think? Do you think we are just out here on the Hopium pipe, or, you know, out in outer space? Or do you guys think that this has a realistic chance of playing out? Once again, we think that 50-day moving average is really important, and that how we interact with that over the next day or two, it really determines. But back over it, we think we're going to shoot up and potentially ring the bell up at 4,600 and maybe even higher. So let us know what you think on that over the next week or so. We do think, though, that at the back half of September, and Bob, I'm assuming you're still with me on that we drop off.
Yeah, for sure. And especially if we hit the top of that range that we outlined in this podcast.
Yeah. So yeah, there you go, guys. Let us know what you think. Please hit like and subscribe. Check out our specials over at tradegenius.co. Also our newsletter. If you guys are active traders, that newsletter gives you a daily guidepost and all the different levels for the trading day as we go into the evening session into the next day. So thanks, guys, for watching. We'll see you on the next episode. Take care.